Good morning, everyone. Today I will be speaking about geopolitics, how conflict shifts individual portfolios. First, let us understand what geopolitics means. Geopolitics refers to the way political decisions, conflicts, and relationships between countries influence global economics, trade, and financial markets. In today's interconnected world, events happening in one country can affect investors all around the globe. Wars, sanctions, diplomatic tensions, and trade conflicts can cause sudden changes in stock markets, commodity prices, and currencies. Because of this uncertainty, investors often adjust their investment portfolios to protect their money and reduce risk. So, in this presentation, I will explain what geopolitics is, how conflict affects financial markets, how investors change their portfolios during such events, examples of geopolitical conflicts and their impact on investments. 2. Understanding geopolitical risk. Geopolitical risk refers to the possibility that political events or conflicts between countries will negatively affect economic stability and investments. Some common geopolitical events include wars between nations, trade wars and tariffs, economic sanctions, political instability, terrorism, border disputes. For example, conflicts like the Russia-Ukraine war or tensions in the Middle East can disrupt global markets. These events create uncertainty. When uncertainty increases, investors become cautious and start shifting their investments to safer assets. 3. What is an investment portfolio? Before understanding the impact, we must know what an investment portfolio is. An investment portfolio is a collection of financial assets owned by an individual investor. A typical portfolio may include stocks or equities, bonds, gold and precious metals, real estate, mutual funds, cryptocurrencies, cash. Investors normally diversify their portfolio so that if one asset performs poorly, others may balance the loss. However, during geopolitical conflicts, the risk level of some investments increases, forcing investors to rebalance their portfolios. 4. How geopolitical conflicts affect financial markets. Geopolitical conflicts can affect markets in several ways. 1. Stock market volatility. Conflicts create uncertainty about the future. As a result, stock markets often experience sudden fluctuations and declines. For example, during the Russia-Ukraine war, global markets experienced volatility because investors were worried about energy supply disruptions. Companies involved in international trade or supply chains may face losses. 2. Increase in commodity prices. Wars and conflicts can disrupt the supply of important commodities like oil, gas, and food. For example, tensions in the Middle East often influence global oil prices because many oil-producing countries are located there. Higher oil prices can increase inflation worldwide. 3. Currency fluctuations. Political conflicts may weaken the currency of affected countries. Investors often move their money into stronger currencies, such as the US dollar or the Swiss franc, which are considered safe during global crises. 4. Impact on global trade. Conflicts can disrupt trade routes and international business relations. For example, sanctions against countries can reduce exports and imports, affecting companies that rely on global markets. 5. How individual investors shift their portfolios. During geopolitical conflicts, investors typically adjust their portfolios in several ways. 1. Moving towards safe haven assets. Investors prefer assets that retain value during uncertainty. Common safe haven investments include gold, government bonds, stable currencies. For example, investors often buy gold during crises because it historically maintains value. 2. Reducing exposure to risky assets. During conflicts, investors may reduce investments in high-risk stocks, emerging markets, speculative assets. These assets tend to experience larger price drops during uncertainty. 3. Increasing diversification. Investors spread their investments across different sectors and countries. Diversification reduces the risk that a conflict in one region will heavily damage the entire portfolio. 4. Investing in defensive sectors. Certain industries perform better during geopolitical tension. Examples include defense and military companies, energy companies, healthcare companies. These sectors may benefit from increased government spending during conflicts. 6. Real-world examples. Example 1. Russia-Ukraine War. The Russia-Ukraine War significantly affected global financial markets. Impact included rising energy prices, increased demand for gold, higher inflation worldwide. Many investors shifted funds from risky stocks into gold and government bonds. Example 2. Trade war between U.S. and China. The China-United States trade war created uncertainty in global supply chains. Companies dependent on international trade faced losses, and investors diversified into other markets. Example 3. Middle East conflicts. Conflicts in the Middle East frequently affect oil prices. Whenever tensions rise, energy markets react quickly, causing investors to shift toward energy sector investments. 7. Role of government policies. Governments and central banks also influence markets during geopolitical crises. For example, governments may impose economic sanctions. Central banks may adjust interest rates. Countries may increase defense spending. Institutions like the International Monetary Fund and World Bank also monitor global economic stability during such events. These policies further influence investor decisions. 8. Strategies for investors during geopolitical conflict. Investors should follow certain strategies to protect their portfolios. Maintain diversification. Invest in safe haven assets. Avoid panic selling. Monitor global political developments. Focus on long-term investment goals. By following these strategies, investors can reduce losses during uncertain periods. 9. Conclusion. To conclude, geopolitics plays a very important role in global financial markets. Conflict between nations create uncertainty, affecting stock markets, commodity prices, currencies, global trade. Because of this uncertainty, investors often shift their portfolios towards safer and more stable investments. Understanding geopolitical risks helps investors make better financial decisions and protect their wealth during global crises. Therefore, in today's interconnected world, keeping an eye on global political developments is just as important as analyzing financial markets. Thank you.